Hey everyone, it's Larry Berman here, and here's what's on my radar this week. The Bank of Canada yet again surprised financial markets with a unexpected rate hike. Expectations for the bank were around 35% in the minutes leading up to the minute that the announcement came out on Wednesday. And there were a handful of economists who changed their opinion on a bank rate hike earlier in the week. But really, it did catch the market a bit by surprise. Friday, we get the employment situation report for May. And of course, Canada loses 17,000 jobs and 32,000, almost 33,000 full-time jobs. Clearly, the bank didn't have the data. And if they did, why would they have not skipped another meeting kind of thing? Anyways, the bank's been tricking the market or just kind of going their own way. And it's really, I think it's actually a good thing, but the market has been conditioned with the Fed and central bank clarity and communications. And the vast majority of movements have been much more certain in terms of what's priced into the market, heading into a decision like this. So we've now seen several times where the banks surprise the market. With that in mind, we look at expectations at Friday's close for a rate hike going forward. If we were to take this back to Wednesday post-meeting, so the employment numbers took down the odds slightly, but not significantly in terms of what the market's still expecting going forward, i.e. more than one rate hike at this point by the October meeting and possibly in September, with still almost a 2/3 chance that they go again in July. So, you saw the RBA in Australia this week, again, surprised the markets, get some bad economic data following it. And it's clear to me anyways, that we're with the sharp uptick in initial claims data in the US, that we're getting close to the inflection point where companies start to lay people off. And that's a good thing from the perspective of what it means for inflation, but it's a bad thing in terms of what it means for financial markets and earnings. It's not a reason to buy equities that we're starting to lose jobs and will likely start to see an impact on earnings over the coming 6 to 12 months. We know historically from inverted yield curves what that means, and we'll take a deeper dive in that in a minute here. Let's look at the S&P 500 price behavior, because we had talked last week about the breakout above 4,200 and where the next resistance was, and we said there was a very good chance that the combination of the August high and the 61.8% retracement of the entire bear move down last year was likely to be the next target and resistance. We saw that on Friday. When we blow that up and look at what happened, we clearly get the sense that the move was rejected. Now, in technical analysis, this is the setup. This is not the confirmation. The confirmation to me would be a close, at least one, below the low of Friday. Higher confidence, a close below the low of the week that the reversal was seen. And really speaking, let's say below 4,100 or 4,050. Now, by the time you get that confirmation, of course, the market's already way off its highs. So what did we do today? We had put protection in our portfolios where we do that for clients at 4,100 to protect all the way down on out through the end of the year. And today we rolled up that put protection. It cost us 1% to do it, but we rolled it up from 4,100 to 4,300 to lock in even more gains this year. And we think that is still very, very prudent. Where's support in terms of a pullback? Well, again, it doesn't take a rocket scientist to look at the previous lows and where the 200-day average is and say, well, the 200-day average is probably the first level of support. These two lows from April and May are probably meaningless in context of the 200-day, and even more meaningless in context of the lows seen in December and March. At this point, getting back to or below the lows from last year seem very low probability, unless we lose a lot of jobs and earnings take a significant hit and the leadership in tech rolls over significantly. It's going to be hard with the average stock flat on the year at this point to see the broader market come down without large cap tech leading the way down. So that's really important. What makes large cap tech turn down? If inflation doesn't come down, again, to put the central banks in a position to start cutting rates in 2024. Higher for longer remains the message from central banks. Looking at what happened in the leadership is very important. The same retracement, the 61.8 and the August highs have been exceeded by the NASDAQ. We know that's where the leadership has been. We know it led to the downside last year. If we blow up the price action here and just have a look at what happened in the last couple weeks, we can see the price behavior all of this week. The market tried to move higher, and pretty much every time we saw a selling tail. Some days more than others. Friday, pretty important. We had a big reversal move on the 7th. That was the day the Bank of Canada moved. There was some thought that meant the Fed was going to move, and therefore, tech sold off and money came into the average stock. That seemed to reverse by the end of the week, and then we got selling again. So it appears to me that the leadership is losing momentum, very important characteristic. You always want to look at what the leadership is doing, and it looked like it had a pretty bad week from that perspective. Conclusive, not by any stretch of the imagination, but if we see the Qs get back below 345, let's call it 347, that would mean a weekly reversal confirmation and much more probability that we are going to see a more material correction in tech. Where would it go to? Initial support around 320 on the S&P, but again, we look to that rising 200-day average for support from the leadership. And where's that from here? 355 down to under 300. Maybe in a few months it's above 300, but you're looking at a 15% correction from the leadership. Broader market, call that 10. And so the S&P 500 at 4,300, a dip somewhere below 400. We talked about those levels, 4,000. We talked about those levels. What did the yield curve tell us this week? It's getting even more inverted. So as the data's coming out, as the days are progressing, the yield curve's now getting more inverted, tells us harder landing, higher for longer, harder landing. The Fed is not going to be easing to come to the rescue. The data points that are coming out that's saying the economy's softening is a bearish thing now. It's not a bullish thing. I think we got to retrain the algos to stop buying technology every time we get a weak data point. The bull and bear pick of the week. Let's look at the gold charts and the gold sector. We know it's been disappointing for the gold bugs out there. We had a great move in 2020. We made equivalent highs in terms of the gold price. Gold stocks just can't move. There is a belief in the gold sector and gold equities that these moves in gold are not sustainable. And until the market actually believes that gold is good again, to me, that means the easing cycle and negative real rates. And we're not there. And we probably won't be there till sometime in 2024. But you should start putting this on your radar again, because from a risk return standpoint, gold starts getting very, very interesting now. And gold stocks, because they're dirt cheap relative to gold, somewhere below $30. I've written puts out to September in this area. I think that is what you want to have a look at and keep on your radar. Do you buy it here at 31? Yeah, you could nibble here. I've reduced my exposure. I cut it in half up here. I'm looking to add that back. I'm looking to be fully exposed to gold going into whatever that easing cycle is going to be in 2024. I don't think we need to rush. If all the Treasury supply coming to refill the Treasury General account and to restock the coffers in terms of the deficits in front of us for the next 2 years of $1 trillion plus a year, that bond supply that's coming, repo is going to suck a lot of that up, and some of the reserves. But clearly, there's going to be some pressure on yields and longer yields rising. And we think that real yield and the longer real yields is going to push us back below 30 sometime between now and October. So when you look at the option market, have a look here quickly. You could see where some of these options are pricing. For a 28, you can pick up 2.5% approximately. For a 30, you can get north of 4%. Get paid to wait, folks. Learn how to use options to extract that premium from the market to buy something you otherwise would have been if you were waiting to get there. Have a great week, everyone.